Hey traders, Raghee here, and in this recap video, let's discuss a topic that I just finished a podcast with the good folks over at Anderson Advisors, and that's something I'll bring up here. We'll probably do another free video with them, a webinar with them really soon. How do you structure your trading as a business, and that'll be something we can talk about. But I just finished a podcast with Toby Mathis over there, and he's a super smart guy, real estate investor, stock investor. And we just finished talking about macroeconomic and the realities right now of the current market trend and what's happening. And I said, it's an interesting time where we're seeing a divergence in the actual stock market trend versus the macroeconomic trend. And it's an interesting divergence because it's really predicated only on one thing. Macroeconomics is the rate of change of certain key measuring tools of any economy. It's not just the US. I would measure any economy with these four things. And you can see it right here on this image. Growth, inflation, monetary policy, and dollar liquidity, but then also currency liquidity for that country. Now, US dollar liquidity is pertinent for every economy because the US dollar is still the reserve currency. It's still the currency that most transactions between countries, not just the US, but any country, is still the currency the transactions are done in. So it's the funding currency, right? Now, when you track these things, you understand very clearly from a rate of change perspective that we are in what's known as the D stage right now, the downturn stage of the economy. And we're probably making a pretty swift shift to what we call the cooling off stage because of Jerome Powell. So we got, as I like to say, cup-howled, but Jerome Powell has shifted this conversation by uttering the word patience, and that's going to help likely inflation possibly start to tick up again. It's too soon to tell, but that's typically what the market's going to start to discount because the expectation is a pause is really just a precursor to eventual rate cuts. I mean, that's what's happening. That's why the equities markets are up. That's why things like crude and copper are up. That's why markets like the bonds are up. So when people ask me, okay, what's happening here, Rog? Why are bonds moving higher? Maybe not at the same rate of change, but why are they in an uptrend while the equities markets are in an uptrend? Well, they're really discounting the same thing. A stop in rate hikes, eventual rate cuts, and a more accommodative central bank. And it's really that simple. Bonds don't have to go down when the equity markets are up. And in this shift macroeconomically, what we're seeing is not unusual. It's just that for a lot of traders and analysts and investors out there, and for many folks, I know not everybody listening, a lot of you, this is not your first rodeo, is it? You think about this. How many shifts since, say, 1987 have many of you seen? I've seen about 6, and I'm sure many of you have seen that and more, depending upon how long you've been watching the market. So for the folks out there where this is their first rodeo, well, this is shocking, right? But not for a lot of you, and certainly not for watchers of our content here at Simpler Futures. And I want to bring this up because we are in a divergence of macroeconomic and stock market trends. Now, one of the questions that Toby asked in that video is something that I want to address now, which is, well, what are you doing now? How do you manage this divergence of the macroeconomic environment and the stock market? Well, it's hard for me to do anything but just as a trader play the stock market. Very, very nimble. I'm not investing in the market yet. I don't mind being long the market for days, if not weeks, but this is not an investment leg of the move for me. But I am long utilities. I am long bonds. I am long gold. And I'm showing you all the ETF versions of this because those of you that are trading futures will know, you can take a look at the ZB contract and the GC contract and the XLU ETF. I mean, you could do that. But I want to show you where I continue to focus on the long side of the market. And it's really important to me that traders understand that just because certain segments of the market, high beta, high momentum, even in tech, discretionary, might roll over again, not everything is going to suffer. And I want you all to understand the importance of a longer term smooth equity curve. I mean, this is really a glimpse into my portfolio management because there's the trader part of my life And there's the investment part of my life. And that was a great conversation. Again, big thanks to Toby over at Anderson Advisor for talking about that, because not all traders are just trading all the time. There is an investment part of our life. A lot of times the watch lists are similar. Two of my biggest holdings right now are gold, are bonds, silver and copper as well. And I'm starting to build a long position in crude. And some of those, about 3 of those, are going to make their way into my longer term portfolio. In fact, they already are. So I hope this was helpful to understand where we are. I don't want everybody thinking this is about a 1-minute chart. Sometimes it's about a weekly and a daily chart. But if you can read the grab candles, understand the market structure, it really is not all that different to use a longer time frame, say a daily or a weekly, and build that longer term portfolio. And I really want everyone to be well-rounded here. And I hope this is a conversation that we can continue to pursue here in these recap videos. So let me know what you think. And I hope this helps, and I'll see you in the next update.